meeting is being recorded.
Hello, everyone. Welcome to today's webinar hosted by Pronovos, where we're covering the work in progress report. We're going to wait a few moments to get started to let a few more people trickle in. I see that there's a pretty decent size attendance now, but there's a poll question that's launched. If you guys could answer it to the best of your abilities, and we're going to just wait a few more moments to get started. All right, for those that just joined, we have a poll question that's prompted. If you guys could answer it to the best of your abilities, we'd greatly appreciate it. We'd like to thank Chris Mast for joining us today for today's webinar. Just a few housekeeping items. If you have any questions, please drop them in the Q&A and we'll answer them at the end of the webinar so we don't throw off the presentation. We don't want you to think that we're ignoring a question. We'll just circle them to the end. And then the poll question, like the one you see popped up, we'll have a few that will pop up during the presentation. So if you could answer them, we would appreciate that. So I'm looking at today's agenda. We're going to cover the importance of the WIP report. Chris is going to go through some essential components in it, such as percentage of completion and some over and under billing scenarios. And then Kevin is going to walk through some common reporting challenges and how you can overcome them with automation and streamlined workflows, and also how to empower your project team with the financial data they need to avoid costly mistakes, and then wrap up with Q&A. So my name is John O'Brien. I'm in the bottom right. I'm the growth manager for Pronovos. I've been here for about 5 years and then working with construction and at the intersection of project and financial management. For those that are Pronovos clients or familiar with Pronovos, they probably know our product manager, Kevin. But Kevin, I'll let you introduce yourself to those that are new.
Yeah, so I'm the product manager at Pronovos, like John mentioned. Prior to Pronovos, I spent 7 years in the construction industry doing project management for a mechanical contractor out here in California. So while I'm not quite the expert Chris is when it comes to this stuff, I like to think I know a thing or two.
You want me to go, John?
Yep, go ahead.
All right. So as John mentioned, Chris Mast, good afternoon, everyone, depending on what time zone you're in. Happy to be here. Appreciate Pronovos asking me to do this webinar with them. I've been at GBQ since 2011. I've worked with contractors for most of those years. GBQ is a full-service accounting firm out of Central Ohio. Got a couple of offices. We just cracked the top 100 CPA firms in the nation, so growing. We've got tax and audit, but also business valuation, cybersecurity, and state and local taxes, all sorts of service offerings. So anyway, been working with construction contractors, and obviously the WIP is the biggest piece of that. I'm on the audit side of the house. And so if you want to go to the next slide, John, we can just kind of jump right in. So who uses the WIP schedule? Kind of working from the bottom up. Again, I said I'm an auditor, so I'm going into construction clients and I'm looking at the WIP schedule to make sure that I can rely on it as part of my audit to present a set of financial statements to the bank and the sureties so that they can rely on the information so that they can continue to give bonds or continue to give money for a line of credit or new debt that comes on. So obviously very important from that aspect, as well as just internally, company management, be able to look at a WIP schedule and rely on those numbers, because there's a lot of potential implications, as you can see on the right-hand side of the screen. Obviously, the inability to obtain that bank financing or bonding, making bad business decisions. So deciding to pay out bonuses because you think you're doing a lot better than you are, or deciding not to pay bonuses because you don't feel like you're doing very well when maybe you really are. You're just not keeping an accurate WIP schedule. And for those of you who maybe are new to construction, I guess I should say WIP stands for work in process. It's the listing of all your jobs that you have going on at any one time. Another big one is either the over or underpayment of taxes. So the IRS is a different governing body than what I'm doing my work for, which is generally accepted accounting principles. But they look at things obviously a little bit different. They want to get their money, right? But you also don't want to pay too early or overpay taxes based on revenue numbers that maybe aren't accurate. Exit planning wise, obviously with the baby boomer generation, a lot of people are trying to think about what the next step is, whether they're passing it down, doing an ESOP, selling to private equity. You really want to make sure that you have the right numbers so that you're getting the best amount of best deal that you possibly can as part of that exit planning. And then just one example from a personal matter standpoint, I had a client a number of years ago that wasn't keeping accurate financial statements and unfortunately went through a divorce and paid out a pretty large settlement based on that divorce. And then the next year, only to see things kind of go the other way with their WIP schedule. So this stuff matters, even though a lot of my clients are very, very good at building. And the last thing they want to do is worry about the numbers. And I certainly get that, but there is such a big implication on everything else in the business that really hopefully pay attention during these next few slides. So next. So what we want to do here today, just real quick for the next 5-10 minutes, and then we're going to turn it over to Kevin to really see the software and go into more of the detail, is talk really kind of high level about how revenue works in construction. And the thing most people get confused by, John, I don't know if you want to even pull up that other poll question now before I get into it. There you go. Answer this poll before I start talking, because otherwise I'll just give away your answer.
These answers are anonymous too, so don't be shy. I think we're about to shoot 100% here. Okay, 94%.
And it's interesting. One of the things I do is I go out to clients and I meet with their project managers and their estimators and their accounting team and the owners. And this is usually the first question I ask to the group. And it's actually very interesting to see the different answers that people come up with.
We'll end it and share it. We got 96%, got it right at percentage complete.
Okay, like to hear that. It helps to have some multiple choice answers there, I'm sure too. So sounds like we got a smart audience. So one of the things I like to point out is this is just a very basic statement of income showing the performance of the company for, in this case, 2020. Most people get confused about what contract revenues earned are in construction. A lot of people, the answer I get the most is billings. So if you go to the next slide, John. What really happens is every time you send an invoice, for those nerdy accountants in the room, revenue is credited and accounts receivable is debited. And so every time you send a bill, you're going to have revenue recognized in your income statement. And what happens with a lot of my clients who aren't as in tune with their WIP schedule is month to month when they're looking at their financial statements and relying on those financial statements, or maybe even sending to the bank or bonding, really all their revenue is what they've billed. There's no adjustment for percentage of completion, which is what we're going to talk about here in the next couple minutes. So next slide. And again, what's important about meeting with the estimators and the project managers and everyone getting them on the same page so we're not working in silos is they have a significant impact on how percentage of completion works. And we're going to get into the equation, but so you'll see how that can impact the ultimate financial statements here in a second. But again, here we're just looking at what an actual contracts in progress, work in progress schedule looks like in the back of a set of financial statements that I would do and give to the bank and bonding company. So the first three columns on the left is the contract as the whole. The next four columns are just for the year, in this case, 2020, how the contract did. And then what we do is we compare contract revenues earned at a percentage completion, which we're going to talk about and walk through a couple examples. We compare earned revenue under percentage completion to what you've billed. And now on the far right, we're either going to be underbilled, so we didn't bill enough compared to how much we earned, or we're going to be overbilled. And underbilling is an asset and overbilling is a liability. We're going to see that in a second. So next slide. Okay, so I promise this is the only math we have, and it's just add, subtract, multiply, and divide. It's nothing. We're not doing any calculus here. So percentage of completion, the first step is you take your actual costs that you've incurred so far. So let's just say it's $10 you've incurred, divided by your estimated project costs. So if your total estimated cost on that job is $100, 10 divided by 100, you're 10% complete. Okay, you take that percentage of completion. That's called the cost to cost method in accounting. There's a couple of different methods that can be used. That's used probably 95% of the time. So you get your percentage of completion, and then you multiply that by your total contract amount. Okay, so if you've got, again, a $100 contract and it's 10% complete, then $10 is how much revenue you've actually earned. Okay, you compare those earned revenues on the bottom there to what you've billed. Maybe you've been able to bill $20, and you're going to have, in that case, an underbilling because we earned $10, but we billed 20. Oh, sorry. In that case, it's an overbilling. We billed more than we earned. Okay, so we're going to walk through a couple examples because I know that's a lot of theoretical accounting and math. Next. Okay, again, just go next. Okay, so here's the first scenario. In this instance, we've got $1 million contract. We've got estimated costs for the whole job of $930,000. So in theory, we're going to make $70,000 on this job at completion. So far, we've incurred $465,000 of actual costs, but for whatever reason, we haven't been able to bill anything. Okay, so I just want to first show you next what the impact on your income statement is before you do a percentage completion adjustment. Go ahead next, John. So this is an income statement before we do a percentage completion adjustment. Again, because we didn't bill anything, no revenue was reported on our income statement, but we did have $465,000 worth of costs. So this is a scenario where maybe you didn't get your bills out at the end of the month, or for whatever reason you didn't bill. Okay, so if you don't have a percentage completion adjustment, it's going to look like you lost $490,000 in this instance. And you might decide not to pay bonuses or whatever your business decision is. Your bank might ask you a lot of questions why business isn't going well. But if you go to the next slide, when we do our percentage completion calculation, we incurred $465,000 of actual cost. We divide that by our total estimated cost of $930. We're 50% complete. Because we've done work, we incurred cost, we actually get to recognize 50% of the total contract as revenue. So in this case, that's $500,000 of earned revenue. We compare that to our billings. And because we billed zero, we are $500,000 underbilled. Okay, so if you go to the next slide, how that works is because we're underbilled, now we need to, again, dirty accountant, credit revenue to increase revenue, and we would debit an asset account called underbillings in this scenario. But what that does is it matches up our revenues with our costs, and now instead of losing $490,000, we made $10,000 just by, again, integrating percentage completion accounting into our system as opposed to having it just based on billings. Let's go to scenario 2 quick, John. So kind of the opposite scenario here. You see the contract amount stayed the same, your estimated costs stayed the same, but now instead of having costs, we have zero costs incurred. But again, for whatever reason, we were able to send out a bill. Sometimes the owners allow us to kind of finance the project that way, or for whatever reason, we're able to send a bill out before we start incurring a lot of costs, whether it's mobilization, whatever it is. So let's look at the income statement before an adjustment, John. So again, because we sent a bill that credited revenue, that debited our accounts receivable, we're showing that in this case, because we have no costs, we just made $475,000, might run out and buy a new boat, whatever contractors like to do, because we see that our financial statements look impeccable. We might have paid out bonuses, we might decide to sell the company, whatever it is, we're making business decisions based on these numbers. So go to the next slide, John. We run through our percentage of completion calculation. Because we incurred no cost, we're actually 0% complete. We multiply that by our contract and we've earned no revenue. We compare that to the $500,000 of billings. And in this case, we're $500,000 underbilled. So let's take a step forward, John, and see what the adjusted financial statements look like. In this case, we actually have to decrease our revenue with a debit to revenue and a credit to a liability account called overbillings. And again, in this scenario, we're actually losing $25,000 instead of where we were. Last scenario, John, if you go to the next slide. So the reason I include this last scenario is you'll notice the estimated costs drop from $930,000 down to $800,000. And this is where the project managers and the estimators really come into the process, because they're the ones telling the accounting team what they think the total estimated costs are going to be. I don't know very many accountants that are actually going out and doing a lot of job site visits, or even if they did, if they could tell what the total costs were going to be based on that visit. So heavily relying on those project managers and estimators to give that estimated costs. And keep in mind, this is one job as we go through this scenario. So $1 million contract, $800,000 of estimated costs, $465,000 of costs to date, and we've been able to bill $500,000. Let's look at the income statement before we adjust. Because we sent a bill for $500,000, we credited revenue and debited accounts receivable, and we had the cost of $465,000, so we got net income of $10,000. Go to the next slide. So again, we take our $465,000 of actual cost divided by now our denominator. The total estimated cost is $800,000 instead of $930,000. So just by decreasing how much we think the job's going to cost, we went from 50% complete to now up to 58% complete. We're further along in the job, in theory. Take 58% complete times our $1 million contract, and we have earned $581,000 of revenue. We compare that to what we billed, in this case, $500,000, and we have an $81,250 underbilling. So let's look at the income statement adjustment. So we were able to bill 500,000. Now we have an underbilling percentage of completion adjustment. Again, in this case, we're crediting revenue 81,250. We're debiting an asset account called underbillings for 81,250. That's the offset. And now instead of $10,000, we have 91,250. So we made an extra $81,000 simply by decreasing our overall estimate. So just absolutely critical. Again, this is one job. You can imagine most of my contractors have 20 to 1,000 jobs on their WIP schedule, how integral it is to get those estimated costs complete correct on your jobs and really have a good feel for your WIP schedule. Next.
I think that's huge, Chris, if I can chime in real quick. I know
Sure.
Back in my project management days, I knew when I did the estimated cost for our CO and our CFO, I understood how it affected the profit, but I didn't understand how it affected when you earned that revenue and profit. So, I would have some projects that went really well. And then at the very end of the job, it's like, oh, we had to write it down a little bit. And those were always the projects I would get in the most trouble because I didn't understand that meant we over-earned the job earlier in the project. So I think it's important not only to understand this when you're putting your WIP schedule together, but also making sure your project team, your project managers really understand it, because if they're not making those adjustments early on, maybe they're holding out hope that they can fix things, then chances are it's going to bite them in the butt towards the end of the project.
That's right. And you obviously have two different types of project managers. You have the project managers that were like Kevin, that always, all the way along, they think, or they say things are going great. And then at the end, you end up reversing a bunch of revenue, which is probably the worst of the two scenarios, to be honest, Kevin, sorry. The other scenario is you've got the sandbagger who says the estimated costs are going to be a lot higher than they actually end up being. And so they don't recognize as much revenue along the way. And at the end of the job, they have a huge write-up. Right. And so to me, as an auditor, to a surety, to a banker, what we want is just what's as most accurate as possible. And I know that that's hard because I have to estimate how my jobs are going to go as an auditor too. And I know how hard that is. And I'm just dealing with labor. I don't have to add materials into that equation as well. So I know how difficult that can be.
It's funny you say that because I sandbagged a few projects in my day too. And I remember when we would get to the job and we'd have that spike in profit at the end, our response I would always get from my boss is, you just got lucky. You didn't actually know where that job was going to end up, because if you did, you would have made the adjustment 6 months ago. So you just got lucky that it was a positive adjustment. It could have just as easily been a negative one.
Yep, exactly. And again, you're just not able to make solid business decisions along the way because you don't know what's going to happen until it's too late. So certainly most people would prefer to be on the conservative end of that spectrum, right? And be a little bit of a sandbagger as opposed to the opposite, where you recognize revenue too early. But from a tax perspective, you could pay some, underpayment penalties, or there are other implications from doing it the other way as well. So just to highlight, underbillings is a current asset on the balance sheet. That's when you haven't billed as much as what you've earned under percentage completion. Typical reasons that you'd find yourself in an underbilling position. So if you're someone that has access to the WIP schedule, the reason I say these things is because it allows you, if you're looking at a WIP schedule or have access to it and you're seeing large underbillings on jobs, these are some of the reasons or some of the things you could start to ask the project managers about. One of the biggest ones is just poor billing practices. So if you don't get your billing in at the end of the month, that's going to drive a large underbilling because you just haven't been able to bill. Obviously, you don't want that, because the most important thing in construction is cash flow. Cash is king. You have to get the money in to be able to, keep paying payroll and pay for materials. You could just have cost overruns that can't be billed. So you think it's going to be a lot better than it is. You just have a bunch of costs sitting up on your balance sheet that eventually are going to fall out. Could be that you have unapproved change orders. So because they're not approved, you haven't been able to bill for them yet. Or you might just have an estimated cost to complete that's just way too low. And that's driving a higher percentage of completion, which is leading to an underbilling. Next slide. Obviously, the opposite is an overbilling, which is a liability on the balance sheet. And what's interesting, I'll point out here too, a lot of times we think of assets as good, liabilities as bad. Really, in construction, it's kind of the opposite for these two accounts only. Don't take that for everything. But really, that underbilling is going to be more scrutinized by an auditor, by a bank, by a surety than an overbilling, because the risk is that, again, you have a bunch of costs that you're not going to be able to bill for. Whereas with an overbilling, it's good that you were able to bill for it and get cash flow in, assuming you're actually holding on to that cash and not, again, buying a boat with it before you finish the project. So An overbilling is when what you build is greater than what you earned a percentage of completion. Sometimes the general contractor will just allow you to do that, which is great because they know you have cash flow issues yourself. And sometimes it could be, again, going back to the estimated cost to complete, it might just be that you're sandbagging and you're saying it's going to be a lot higher than what it's actually going to be when the job finishes out. Next.
Yeah, one real quick comment on the over under billings. One mistake I know I made a lot when I was doing my projects is I wouldn't spend a lot of time constructing my schedule of values in a strategic way. And then I would be living with it for the rest of the project where I just had a bad schedule of values and I would be underbilled. So that's one other thing just to keep in mind, that is kind of a sneaky leader to over or under billings one way or the other.
Yeah. So in terms of identifying bad estimates, again, if you have access to the WIP schedule within your company or me as an auditor, these are the things that I do to identify bad estimates. One is looking for large over and under billings and just asking why those jobs are large over and under billed can lead to a lot of comments on maybe the estimate wasn't as accurate as it should have been. If you've got gross margins that look like they're outliers compared to your typical gross margins, that could be that it's a bad estimate. One of the best things is just to have really good communication, again, between the accounting and the field. A lot of the times, the people that have the inaccurate WIP schedule that I work with is because the accounting team and the operations team are not talking. Operations doesn't see the value in giving accounting accurate, updated numbers because they don't understand percentage of completion accounting and they don't understand the overall impact. So I do see a poll just popped up. John, if you want to say anything.
Yeah, we popped up a poll question just to get some feedback. Chris, how often would you advise your clients to review the WIP report? Like, what's too much? What's too little? What's the perfect?
The Goldilocks. Should I wait
Yeah.
until after they answer? Just kidding. So I mean, I would say the best contractors are having monthly project manager meetings whereby the accounting team is typically leading that process by giving them, reports that can show them where their jobs are at and then asking them to fill in like a percentage completion update. I do also work with contractors who do it quarterly or don't do it until the end of the year when I come in to do the review or the audit. And so again, if you're not doing it on a monthly basis, your financial statements are going to be based on billings. And so just based on when you bill, it might be a bit of a roller coaster. And if you're sending those financial statements to the bank, they don't like to see large fluctuations month to month that aren't legitimate. So it comes back to be a credibility issue. And the people that really are meeting more often on a monthly basis and having those discussions and touching base on what's working, what's not, are the ones that are going to squeak out the extra 1%, 2%, 3% margin on jobs. And sometimes in construction, that's what the difference between being profitable and not.
Mm-hmm. It's like 2/3 of the response was monthly, Chris. So you didn't influence that too much.
Need to hide them. And go back one slide real quick, John. Sorry, I had one or two things on that. Unless you're cutting me off.
Oh, we're not. There you go.
If you can't, it's fine. Okay. Yeah. So then obviously knowing your people, as we talked about before, so you might have some Kevins on your team that are being too aggressive, or you might have some others on your team that are being sandbaggers. So you just need to know your project managers. A lot of my best clients, they keep the WIP schedule by project manager so they can really track jobs that way. I know Pronovos allows that the ability to filter by that as well. And then lastly, a gain fade analysis. That's something I do. It's something I know a lot of sureties do, probably the banks as well. Let me show you an example on the next page. What a gain fade analysis is, it's a hindsight review. So those first 6 columns, if you see at the top, 12/31/2020, and then the next 4 columns are 12/31/2021. What's happening here is what we do as part of the audit is, let's just say I'm auditing 2021. I will look at all jobs that were in process at the end of 2020, and I will see where they finished at the next year. So in 2020, it was an estimate. In 2021, the job has finished or is closer to completion. And so I will ask in this scenario, all 3 of these scenarios, the estimated costs in 2020 were $700,000. In 2021, you can see the estimated costs have gone anywhere from staying at $700,000, increasing to $875,000, or decreasing to $500,000. There's the second to last column there is it's showing how much revenue should have been recognized last year based on what we know now. And again, it's never going to be perfect because it's nearly impossible to estimate, but it's showing how much revenue change in that last column you have between what you actually recognize and what you should have recognized. And if that number becomes, from my standpoint, material to the users of the financial statements, we typically have a footnote in the financial statements saying that fact. And so again, it just gets back to credibility issue with the people who are using your financial statements. Can they rely on your current year estimates when their prior year estimates were bad?
Mm-hmm. Yeah. Kevin, if you want to grab the screen, just a reminder, we might be running over a little bit, but if anyone has any questions, feel free to put it in the Q&A.
Yeah, and what we're gonna go through now is Chris did a really good job of covering what the WIP is, why it's important. What we're gonna spend the last few minutes on is what are some of those best practices that you want to follow when you're producing that WIP report. And what we advocate for and what we do here at Pronovos is what we call a cloud-based WIP automation solution. So what this means is you're not having to manually create the WIP. You're not having to export in our data from the accounting system or import things. Basically, all the data points you need, contracts, budgets, costs, billings are automatically flowing into the WIP. And then that way the WIP is getting produced almost for you, and you can spend your time focused analyzing the WIP. So this is important for a few different reasons. One, it means the WIP is always up to date. So like Chris said, typically, if you're a really good contractor, you're doing your WIP report once a month and to make sure those financial statements are accurate. And that's a really important process. But what we see a lot of contractors do is they're also using that WIP report as basically a bellwether for what's the financial health across all my projects. And if you're only doing that once a month, that means the second you finish it and you have job costs come in the next day, that information is obsolete. So having an automated solution where that data is flowing in automatically, yes, you can still do that official once a month WIP analysis, but then it's also allowing you to analyze the data on an ad hoc basis as well. The second one, it's a very tangible, practical reason. If you want to have just a standard process, if you're having to manually enter things, import, export, copy, paste, add formulas, it's really just to make a typo, screw something up, and then you're carrying that over your financial statement. So having something that's automated, it's a really good way to cut down on the potential of those errors. The data is always going to be accurate because it's automatically flowing. The next reason, and this one's maybe a little controversial, but at Pronovos, we really push for, you want to increase who has access to the WIP. So obviously it's going to be the CFO, the controller that produced the WIP. They're going to be the ones that are ultimately responsible for the accuracy of the financials. But I think what most contractors and construction companies would say is it's really the project team, the project managers, the project execs that have a lot of say in terms of the accuracy of those numbers. So Chris, I'm kind of curious from your perspective, when you work with your clients, how do they typically divvy out access to the WIP?
Yeah, I feel like it's mostly the accounting and finance team,
Even
though that's not necessarily how it should be, but they do in those monthly meetings, at least for those like on their jobs, they see it. They might not see the whole company's WIP schedule, but they see it for their jobs. I think that's probably what's most important.
Yeah, and that's when you have a more automated solution, what you can do is you can give them access to it at any time. You can control it, so maybe they're only looking at their jobs, but I think you don't want your project managers only looking at their job cost or whether they're over or underbilled once a month. You want them to be intimately familiar with the financials on their project. So if they have that access at all times, chances are it's going to give them more of the information they need to do their job better. And then the last reason that you want a more automated solution is it's going to allow you to basically create different versions of the WIP, slice and dice it different ways to look at it, try and identify patterns and trends. If you're manually producing it, obviously most of your effort's going to be put into actually creating the WIP, and you're not going to be creating a bunch of different versions of it where you're looking at it from different angles. So really what we're talking about here is you want to look at ways from turning your WIP report from just a static report to something more of a dynamic tool that you can use day in, day out to really understand the financial health of all of your projects and make more data-driven decisions when it comes to your projects and your business decisions. So we're going to take a real quick look at what the WIP looks like in Pronovos as a kind of a quick example of what a cloud-based automated WIP could look like. So again, the first thing you're going to notice here is all of this data is coming directly from the accounting system. So nothing's getting manually entered, nothing's having to get imported or exported out of the accounting system. Basically, all those data points are flowing directly into Pronovos. And then what you'll see up at the top here are some key KPIs. So obviously, a lot of the WIP is focused on the project analysis at the project level, understanding the financial health of each individual project. But it's good to pull up to that 10,000 foot level and say, hey, how are we performing as a company? So I can look at this here and say, hey, we're doing pretty good on our billings. We're $1.5 million underbilled. On the flip side, I can see we only have a total backlog of 3.5 million against a total contract amount of 23 million. We're really going through that backlog, and I better get out there aggressively, win more work, or in a couple months, we're going to be in real trouble when we've exhausted that backlog. Underneath that are a few charts. I like to say it's a cliche for a reason. A picture's worth 1,000 words. Typically, if you're a contractor, especially a large contractor that has dozens or hundreds of projects on your WIP report, it's going to be really hard to identify some of those patterns and trends. So having these charts, having these visuals, it's going to make it easier to kind of pick out some of the common themes you're seeing play out across all of your projects.
I think that's so important for those monthly meetings with project managers too. What historically happens is you have a bunch of printouts from an accounting system that are archaic and just they're not visually very pleasing. And the last thing a project manager wants to do is spend their time looking at that stuff and trying to explain why, it is what it is. And I think just giving project managers these visuals is huge for those meetings.
Yeah. I mean, I remember when I first started in the industry. I mean, again, this was about 7 years ago. We would have our monthly review meetings, and there would be a line at the printer because all the PMs were printing out their job cost reports for their half dozen projects. And then you'd be in the meeting, and everybody would be flipping around, and you'd end up in these weird rabbit holes where you're trying to get down to this very minute level of data and detail. So I think you're right. Just being able to kind of say, hey, at a kind of high level, how are we doing here? It's a really good way to kind of ground the conversation and make sure you're focusing on the most important things. Down below here, you'll see the actual project list on the WIP. So this is where you have kind of everything you would expect to see on the WIP report: your contract amount, projected final cost, earned revenue, job cost to date, percent complete, bill to date, over under billing. So everything that comes standard on the WIP is available as a column here. What's great about having a solution like Pronovos is you're not confined to just what those standard columns are, right? Like I was saying, most contractors, they're using the WIP not only to get their financial statements accurate, but to really understand the financial health of all their projects. So what you can do is you can edit the columns here. So you can say, okay, here's a metric that's really important for us. Maybe, cash flow has been super tight recently, and I want to understand how we're doing collecting payments on all of our projects. I can add this cash received to date, and now I'm looking at, okay, are we behind on collecting on our projects based on what we've built? So maybe that cash received isn't necessarily important to do those financial statement adjustments that Chris talked about, but it can be really helpful for getting the full holistic picture of how your projects are performing financially. So Chris, I don't know if there's any metrics that you would like to see on the WIP or you've seen your clients include, but yeah.
I think the biggest thing for me, and the reason I made like Pronovos the most, is a WIP schedule in Excel, in the past could have been great, but the problem is we have to be able to reconcile current year costs and revenue back to the income statement. And it more often than not, that Excel WIP schedule looks great, but it doesn't reconcile back to anything because you only keep it at the total contract level: total cost to date, total contract to date, total revenue to date. We have to be able to break out what was earned in a prior year versus what was earned in the current year to be able to show that the schedule is complete and accurate in a set of financial statements. So be able to break down those columns in terms of that can save an immense amount of time. I mean, that's usually where I spend most of my time when I'm doing an audit, is trying to reconcile revenues and costs when, in this case, it's just a drop down.
Yeah, so here you can see we've got our year-to-date columns. We've got our prior year columns, so you can just quickly add those. And what's great is you can also build different versions of the WIP. So if you want to say, hey, I want, columns where I'm just doing that year-end audit to kind of compare how it was in the priors, you can do that. The other thing you can do that's really handy is you can use these filters here. And one really crucial filter here is there's a through date filter. And this basically allows you to run the WIP ad hoc as of any date. So if you say, hey, I want to know what was our WIP schedule at quarter end, or I want to know what it was at 12/31 at the end of last year, I can kind of quickly do that where I go back and say, okay, now I can see what the WIP looked like as of 12/31. So there's a lot of flexibility that you can do with things here. One other kind of quick trick I'll show, because Chris, you mentioned it, I can go my group by here, and I can group by project manager. And now this is going to organize all of my projects by the PM. So I can kind of look at, hey, how are certain PMs performing? Are certain ones really good at overbillings, underbillings? I can kind of get insights into the strengths and weaknesses, not only of my business, but also my people as well. So it gives you really good insights based on that. And I know we're already over here, so I'm going to wrap this up real quick with just one more point. Is Chris mentioned that when you're making sure that you're earning revenue correctly on your projects, probably the biggest variable is making sure you have an accurate estimated final cost or projected final cost. So you can see we have that column here. And what you can actually do is you can drill into that project. And there's a tool there where the PM can actually go in and update their forecast at the cost code and the cost class level to make sure you have as accurate of a forecast as possible. Now, there's a lot to this tool. There's some really cool features where you can select kind of the root cause behind those adjustments, so you understand the whole story of how you got from point A to point B. There's different ways you can do it. We're running over, so I won't have time to get into it today. If it kind of piques your interest, I certainly suggest you reach out to Pronovus and maybe we can give a demo. But John, I'll kind of pass it back to you to close up here.
Yeah, appreciate that, Kevin. Like Kevin said, if you guys are interested in seeing Pronovus a little further, you can schedule a demo. I'll prompt a poll. For select ERPs, we will also do a data demo sync, so you can view your data back in Pronovus. Again, that's for select ERPs. If you indicate interest, you can talk to one of our solutions advisors to figure out if you're qualified to do that. So Pronovus offers the WIP report, the PFC, which is job cost forecasting, revenue forecasting, cash flow forecasting, dashboards, interactive dashboards for executives, financial managers, and the project team. So I'll move on from the shameless plug and we'll wrap it up. So I don't see any questions popped up, so I'm guessing that's an indication on how well Chris and Kevin presented.
Sure.
So we'll take that. But if you guys are interested in reaching out, Chris and Kevin's email addresses I left up, so you guys feel free to reach out to them. And I'll let you guys close if you have any thoughts.
I would just say again, like I know we just looked at the WIP schedule today, but they have so many good tools and it's such a reasonably priced program. I'm trying to get all of my clients to use this, not because I get any money for it. I'm not getting any kickbacks, I promise you, but it's just such a good tool to make your jobs better. And I think everyone's happier when everyone has a better understanding of what's going on in the jobs. There's just less questions overall. So thanks for having me, John and Kevin.
Yeah, no, we appreciate you giving us your time, Chris. Chris is always a wealth of knowledge and easy to talk to. Chris is a big crypto guy as well, so we'll go ahead
Don't say
and drop
crypto.
that
I like
in.
Bitcoin.
Yeah,
There's a difference.
Bitcoin. Sorry about that. But no, we appreciate everyone showing up. A recording of today's webinar will be sent to everyone, and we hope everyone enjoys the rest of their day.
Thanks, guys.
Thanks, guys.